It's been a dismal start for the Chinese stock market this year, the worst since 2016. This month, China's markets have mostly been in the red. The country's benchmark stock index, the Shanghai Composite, has plummeted 7% in 2024 so far. And the CSI 300 that replicates the performance of China's top 300 stocks has dropped by 6%. Hong Kong markets are also on a downward spiral. The Hang Seng Index has crashed about 10, 11, 12% so far this year alone. If the numbers seem confusing, here's another way to understand this. It's not just a bad start to 2024 for Chinese and Hong Kong shares. They've been going rough since 2021. That was when they had reached a peak. Over the past 3 years, China and Hong Kong stocks have lost some $6.3 trillion in market value. That's roughly twice the annual economic output of Britain. The stock market rout has severely hampered investors' confidence. It has left many traders wondering when or if things will improve. The bigger question now is what is causing the slump in the markets. The world's second largest economy is plagued by a myriad of problems. To begin with, China has been seeing a patchy economic recovery since the 2020 COVID-19 pandemic.
Our expected GDP growth rate is around 5.2%, which is higher than the target of around 5% set at the beginning of last year.
In 2023, China's economy grew by 5.2%. And although it hit Beijing's target, it was one of the lowest readings in the last decade. That is, barring 2020 and 2022, when China was reeling through the COVID-19 lockdown. Despite the pandemic shocks, 2021 saw better growth than 2023. Besides, many economists believe China's growth will slow down this year. As per a report by Morgan Stanley, China's tepid growth will weigh on the entirety of emerging markets. In addition to this, China's deflationary pressures just aren't going away. While other foreign central banks are dealing with inflationary pressures, China is the only major economy where prices are falling. Analysts say this is particularly challenging because Beijing is also facing elevated debt levels. Chinese cities have accumulated a massive amount of hidden debt. That's following years of unchecked borrowing and spending. Total government debt estimatedly stands somewhere between $7 to $11 trillion. That's according to the International Monetary Fund and Wall Street banks. This has been exacerbated by defaults among China's real estate firms. Since 2021, China has been reeling through a massive property sector crisis. China's Evergrande became the poster child of China's property market downturn. It holds around $300 billion in liabilities. Morgan Stanley says China faces a 3D problem. The economy faces challenges in terms of debt, demographics, and deflation. Which brings us to the final point, which is China's declining demographics. In 2023, China reported a record low birth rate. It was the lowest since the founding of Communist China in 1949. China's population fell for the second year in a row. It shrank 0.15% last year. That's compared to a decline of 0.06% the previous year. In 2022, China recorded its first population decline in decades. In 2023, some 9.02 million babies were born, which is a decline from 9.56 million births in 2022. This threatens China's workforce, which further dents its growth prospects.
China has been leading economic growth in the world for the past decade or two, actually for the past 20 years. And now, coupled with policy mistakes and also population decline, and China's economy just stopped growing. And that's why you have the stock market falling sharply recently, and Hang Seng Index falling below 15,000. Now we want to see, everybody wants to see the government announce some measures to lift the market, basically to lift the controls over the economy.
After this month's heavy sell-off in Chinese markets, Beijing made a big move to stimulate the economy. It made a sudden cut to its reserve requirement ratio. The reserve requirement ratio is the amount of cash banks must hold as reserves.
Starting from February 5th, we will lower the reserve requirement ratio by 0.5%. We will inject 1 trillion RMB liquidity into the market.
China announced the biggest cut in over 2 years, and this was beyond most analysts' expectations. The central bank's sudden action shows that authorities are growing increasingly anxious. Meanwhile, reports say the government is mulling a rescue package. Policymakers are reportedly seeking to mobilize a package worth about 2 trillion yuan or nearly $300 billion. The money is expected to come mainly from the offshore accounts of state-owned enterprises. The deliberations are emblematic of the heightened urgency amongst Chinese authorities to stem the rout. Reports add the formation of a fund has been on the cards since at least October. However, some investors have raised doubts over its efficacy. That's because Beijing's previous rescue efforts haven't always worked. The deepening stock market turmoil highlights a crisis of confidence among investors. Traders are concerned about the country's future. People are becoming increasingly gloomy about China's economic outlook. The sell-off has also triggered public anger on Chinese social media. Topics like market plunge and China's stock market rescue were trending in China's social media platforms in January. The astonishing losses are reminiscent of China's stock market crash of 2015 to 2016. But the economic backdrop of 2015 was very different. This time around, investors are keen for more concrete steps from Beijing, and only time will tell if the country's new measures will appease them. With investor optimism declining at this pace, is a quick turnaround a tall order for China?